Welcome, everyone. We're going to talk about some great topics, how to create a blueprint to achieve amazing wealth through a combination of the trifecta effect, how to build your real estate portfolio with a combination of short-term rental, medium-term rental, and long-term rental. Once again, this is Seewing Yee. Welcome to our podcast. And my special guest is Julie. How are you, Julie?
I'm good. Thank you. Thank you for having me today, Seewing.
Yeah, the reason why, once again, I invite Julie to my podcast is because she's one of my top coaching clients within my network. And she just a short periods of time, she have purchased in the past couple of years only, she have purchased 6 rental cash flow properties out of state, far away from where she lives. So she's doing very well and she's learning like everybody else. By no means she's an expert at what she's doing just because she owns 6 rental properties, which is more than 99.9% of the population out there. So congratulations, Julie.
Thank you. Thank you very much.
So Julie have a very good mindset. She, again, she's learning, but she's always learning. I'm always learning, and I've been doing this for a very long time. So today is a very exciting topic, and Julie, she's putting herself in the shoes of a typical real estate investor. What's the next strategy? What's your next action plan? And by learning and educating and taking action, Julie is on her way to achieve tremendous financial freedom goals. So, Julie, thank you for attending. So,
thank you for having me.
Yeah, without further ado, let me share my screen and let's get the show started. And again, blueprint, the trifecta to rental real estate. Build your powerful real estate portfolio with the short-term rental, mid-term rental, and long-term rental. Very exciting topic. Let's get the show rolling. First and foremost, I want to take a step back and just to reiterate the importance of income property. As you can see, I know I discussed this a number of times. Julie, you see this high-level concept, but I'm going to share this with you once again. Then on this couple of slides show, then I'm going to have Julie to make a quick comment. Then we will proceed into the next slide show. So a lot of great things to talk about. So income property, rental property is history's most powerful and proven multi-dimensional real estate asset class. Wow, that's a mouthful. So you make money more than one way is much more than first year cash flow. You make money 5 different ways: cash flow, tax benefit. And we can talk about tax benefit momentarily. Appreciation, long-term growth. You leverage using other people's money, getting a loan, leveraging your wealth as well. And also there's more. There's
But wait, there's more.
Exactly. It's an infomercial, by the way.
Exactly.
Yeah, real estate income property is very different than other so-called asset classes. It's very different than stocks, bonds, crypto, bitcoins. Because when you purchase those type of investments, you're done. There's nothing you can do about it. There's no pivot. There's no other areas you can get into. But however, rental property is much, much different because once you purchase an income property, you can convert it into a Airbnb, short-term rental, mid-term rental. You can add an ADU. You can rehab the house as a value add to bring more value, more equity. You can characterize a rental into an owner-occupied primary home. You can convert it into a vacation home. You can do a 1031 tax-free exchange. You can refinance the equity of your properties. So the whole 9 yards. So with that in mind, go ahead, Julie. Can you make a quick comment? And so what is your takeaway from the concept which I just shared?
I'm actually very excited that you're doing this topic with the long-term, mid-term, and short-term rentals. Because when my husband and I first got into this business a couple of years ago, our goal was buy and hold, which is a very long-term strategy. But obviously through listening to you and just keeping up with what's going on in the industry, midterm and short-term are very popular ways of building wealth as well. So I'm very interested to hear more about this so that I can learn to help diversify my portfolio.
Exactly. Very good. Very good to hear. All right. So let's continue. So the question is, the foundation, my philosophy still stays the same. Over the past 20 years, I've been running my real estate business. First and foremost, buy long-term rental, because this is the bread and butter of long-term investing. You will set it, forget it, invest passively, and let the property manager and everybody else do all the dirty work, and you sit back, relax, now almost become passive. So I'm not asking people to get rid of long-term rental, not at all, but buy your real estate portfolio with a long-term rental concept as a philosophy. Then down the road, once you do more research, depending on what market you buy, then you could potentially pivot into short-term rental or mid-term rental if you want to do that. All right. So it's just an option that are available to you. So people ask me, like, where can you best buy long-term rental, mid-term rental? My answer is the fastest growing regions of the U.S., very affordable, where you can cash flow, up and coming markets, new markets, the path of growth, and they are all over Florida, Southwest Florida, Central Florida, Northeast Florida, and Texas submarkets. The big five, there's no longer the big four: Austin, San Antonio, Dallas, Houston, and South Texas. I'm talking about suburbs, 1 hour beyond the metro. You can no longer cash flow in those very expensive inner metros of those cities. And North Carolina is also Raleigh, Durham, Charlotte. And of course, there are other markets in the U.S. where you can do all this. But Julie and I agree that the best areas to buy are in the South and Southeast, and sometimes in the Midwest. You can use this kind of trifecta strategies as well. And of course, use preferably, especially when you're very busy, when you have a full-time job, and especially when you live in an expensive market such as California, New York, Chicago, or the Northeast, somewhere where buying in your neighborhood is just does not make sense. You have to go out of state. You have to go buy long distance, all those kind of things. You prefer to use a trusted turnkey provider, buy new constructions. That's ideal in the path of growth, and use property management. Okay. What are your quick thoughts on this particular comment here, Julie?
I think where my husband and I bought initially, up in the upper, what do you call it? New York area, upstate New York area.
Yeah, upstate New York.
And for us, the goal was cash flow. And that's where we found the best cash flow. But I also realized that there are other states moving more south, like you said, Texas, even didn't mention it, but like Alabama, Tennessee. That is a goal that we're looking at, because those are very up and coming areas. Particularly, I think when you first spoke to us, when I was on your video 2 years ago, or your class 2 years ago, you talked about like that Huntsville, Alabama area, because they have the whole Rocket City and all that. A lot of military, a lot of families, very stable incomes and things like that are coming into that area. So it is definitely something that my husband and I are looking at. So yeah, I definitely think that there are options. And again, I think I really want to stress with your audience, we live in California, and I have been to very few states in my life, but I've never been to New York, which is where we own all of our properties. So it's a very viable, simple way to build your wealth, and you can do that from your home computer. So I just really wanted to add that too.
Absolutely. Absolutely. Thank you for sharing that with the audience. And let's continue with this. And then the next slide. So we're going to use this property as an example. I could use any example of a single family home up to 4 units, but this is a real life example. I'm using South Texas, a property that we are promoting on this new construction fourplex new construction in South Texas, 535K, as an example to articulate my point in this particular topic. But of course, I can use any property anywhere. But anyway, so as a long-term rental, when you buy this fourplex, brand new in South Texas, you buy for 535K, rent for 5,400 on all 4 doors, which is amazing. Which is even at today's rate at 7.3%, 30-year fixed rate mortgage, you still cash flow monthly at a whopping $1,000. Imagine that, right? This is it missed the 1% rule, as you can see the upper right hand corner, which is unheard of in this day and age, especially new builds in the fast growing growth market in the South and Southeast. The point is, when you buy this property, go ahead and you don't have to do a rate buy down because the builders are not giving you any incentive in this particular market, unfortunately. So it's okay. Get the 7.3. You date the interest rate, but you marry the house. In the next few years, when the mortgage rate comes down below 7.3%, whatever, you can always refinance. And once you refinance, your cash flow will be much higher than $1,000 net.
But even at the $1,000, if you're looking at it at being a fourplex, that's an average of $250 a door. Which when I go in looking at a property, that's about what I'm looking for in terms of cash flow for a single unit, like $200, $250, $300 of cash a door. But if that's a quad, that lines up right in with that strategy. But I think the other thing is, and I even realized early on in my career with you, even just to look at the cash flow is a very narrow-minded way to look at it. Because like you were talking earlier, there are these tax benefits and savings and just all these things that will really benefit you at the end of the year when you do your tax. I think a property like this, I will tell you this, if I had the money, I'd buy it right now.
Absolutely. In this pro forma, per door is only about $130,000. Per door, per unit, it rents like $1,250, $1,300. You can't ask for anything better than this.
Right.
Yeah. Anyway, this is a good example. Okay, now let's talk about something you understand a little bit, Julie. Taxes, real estate taxation, because you have a previous experience in your other occupation years ago. But again, someone. By the way, I'm not a licensed tax advisor. This is just an educational podcast. So please, whoever watching this, consult your own licensed tax advisor or your financial advisors to go over your situation. But with that said, so you can potentially do cost segregation. Now, before I even go there, because one of the tax benefits associated with owning an income property, you get the paper depreciation write-off on an annual basis over the cost of the house, which is 27.5 years. In this case of this fourplex, $535K divided by 27.5 years, annually, you're getting almost 20 grand in paper depreciation offset. They can potentially offset your taxes to the tune of 20 grand, but cost segregation allow you to break down the cost structure of a property, and you can accelerate your depreciation 3 year. There are some items inside the house is 3 year, some are 5 year accelerated depreciation, some items are 7 year, some items are 10 year. Again, I'm talking at a high level. I don't want to spend too much time in any one topic because we have a lot more to cover on this presentation, on this video. But suffice to say, but if you accelerate your paper depreciation using cost segregation study, I use an arbitrary figure. You can accelerate 35% of the total cost of the property, 35% cost segregation multiplied by the entire property, $535K. Potentially, you can get a paper loss. My numbers could be off again. This is just a concept, all right? Theoretical scenario, okay? Don't hold me on these numbers. I may have miscalculated something. I don't know, but I just finished this PowerPoint prior to our presentation on this webinar. Anyways, your passive losses, it can be as much as on this one property. The first year, you can claim as much as $187,500. This is a passive losses on, and then you can just do the math, right? You put 25% down payment on this property, 140 grand out of pocket. You're getting $187,000 passive losses. If you can write off all these passive losses against your ordinary income, if you're in a 31% federal tax bracket, for example, you can put around $58,000 back in your pocket. Again, I'm not saying every investor can do that because your tax situation is very, very different from person to person. Consult your tax advisor, but this is the best case scenario. You can get this amazing tax benefit just by doing the cost segregation. Now, the limitation, again, I don't want to bore people, but I'll be real quick about it. Every investor, when they buy income property, giving their income situation, they are subject to passive loss limitation. Ordinarily, the rental income can only offset. Rental property is by definition a passive activity. You can only reduce passive losses against the passive income, and anything you cannot claim in the current year had to be suspended of the passive losses for future years. So having said that, the law is that such that if your adjusted gross income, married filing jointly, is 100 grand or less on a particular year, you can only deduct up to $25,000 of depreciation rental losses against your active income. However, if you make more than 100 grand per year and less than 150 grand, there's a phase out loss deduction, $1 for every 50 cents. And then also, and furthermore, if you make more than $150,000 of adjusted gross income, any kind of depreciation passive losses have to be suspended indefinitely for the future years to offset against future passive income, or when you sell your rental property, the accumulation of the suspended passive losses can offset any taxes you may trigger if you were to sell some of your rental property, whereby you do not need to do a 1031 tax deferred exchange in the future. So just give it a thought. So any quick comment?
A lot of tax information, and all I can say is when we do our taxes for next year, or actually for this year, it'll be the first year we'll be able to take advantage of all of this that you're saying for all of our properties. Because we now have the 4 that we have leveraged through loans, we'll be able to take advantage of everything you're talking about. So I'm looking forward to seeing my big check.
Exactly. That just goes to show you income property, as I alluded to at the beginning of this presentation, is a multi-dimensional real estate asset class, and tax benefit is another, one of the bonus that you're getting. Anyway, if you make more than $150,000 adjusted gross income, marry or filing jointly, whatever, especially, you can become what the IRS definition of a real estate professional status. If you're able to become a real estate professional, it's a very technical term. I'm not talking about being a realtor or being it's not that. But if you're able to do that, you can potentially write off all the passive losses against active income. You're no longer or limited to the bucket of passive income versus passive losses. So that can really reduce your taxes if you qualify, which is not easy. Again, I'm not going to take a few hours to talk about this real estate professional rule, but I'll give you some very simple scenario. You must spend like 750 hours per year in the business of real estate. You have to do some material participation. So if you are a single individual, if you have a full-time job, normally you cannot qualify as a real estate professional unless you're married filing jointly and your non-working or part-time spouse could become the real estate professional. So she will do all this material participation, 2,750 hours. If you follow all the rules, again, all the passive losses from rental real estate can be offset against your active income, which is an extremely significant tax benefit, right?
No, that's huge. And that's huge. Actually, I think that's something that I might try to look into. I know there is a qualification about who manages the property, but I think that again would be another advantage because I'm a non-working spouse. My husband still works and I'm a non-working spouse.
That's right.
So that's something that we definitely take advantage of in the future.
That's right, Julie. That's right. You by continuing learning, and for me and other sources, you're positioning yourself for some real future great real estate opportunities. So again, Material participation rule, again, you have to be involved in your risk activities. Most likely, you cannot use the services of a property manager, because if you do, you will become very passive. You will not meet the material participation test. Okay, all right. For those of you who are watching the video later, you can pause the slideshows to digest this technical terminology, but I'll leave it up to you. So I have to go on. I got many slides to show you. Anyway, it's not easy. But by the way, when you buy income property, anyone out there, you're first and foremost, the property itself must be a good property. You must buy in a good location, good cash flow. You don't buy a property just because you can claim tax benefit. Your tax benefit is a secondary benefit for you. It's not a primary goal. Your primary goal is buy a property that the numbers make sense. It'll cash flow in a low entry point property where the rent will exceed your expenses. Do you agree, Julie?
Oh, absolutely. Absolutely. Yes. Yeah. I think the longer we stay in the business, the more you realize the advantage it is. And like I said, when we first came into it, we were strictly looking for cash flow. But as I progressed as an investor, I realized that there's so many more ways to take advantage of with the tax benefits and things like that that don't show up necessarily at first look.
Yep, exactly. That's why your real estate investor have to take a holistic view of their situation. They cannot. It's not all about cash flow. You have to look at all areas of your real estate portfolio. One thing that some people may not be aware of, there's a short-term rental tax loophole. Okay, in the past decade, a lot of people have entered the short-term rental space, and I'm not saying all of you should do that, but it's an opportunity for long-term investors to pivot, to allocate some of their properties to potentially do a short-term rental. As long as short-term rental property itself, it cash flow. It's a good area. The numbers make sense. You do your research and due diligence. Some of you have a long-term rental property anyway, annual lease. You could potentially convert into a short-term rental. Julia, my network promote properties in the great areas, fast-growing areas in Florida and Texas and few Alabama and in Midwest, Buffalo, New York. There's some opportunity to do short-term rental if you want to. You have to do some determine whether it's right for you or not. But short-term rental, the tax benefit is amazing, because when you buy a short-term rental and you material participate, you manage your own property. If the average rent on your short-term rental is less than 7 days on the average, you are no longer a passive investor. You can potentially offset the passive losses associated with your short-term rental property against active income, right?
Wow, that's great.
Yeah, because short-term rental is an active business. It's no longer a passive rental real estate. Again, Julie, taxes more than many other real estate investors. But when you buy rental property and you have property manager manage it for you, which is our core philosophy anyway, you file a Schedule E, the supplemental income schedule for passive investor when they own out-of-state rental properties. But when you become a short-term rental property owner, you're no longer a passive. You are in a business of real estate. You are a business of hospitality. You're running a hotel, right? So
exactly.
So you file a Schedule C, self-employed profit and loss business owner, or some kind of corporate entity like an S corp or LLC or C corp, whatever. Again, you have to do a material participation. You have to do all the work yourself. You cannot delegate, but the tax benefit could be tremendous. With that said, do you have any quick comment concerning this short-term rental tax loophole, Julie?
It's a very interesting subject. When I hear a lot of people talk about the Airbnb concept, and I've heard some good stories and some nightmare stories as well.
Right.
But I think like any investment strategy, you really have to do your due diligence and make sure that it's something that can work for you. But as you're talking about like the long term, midterm, short term, I kind of envision like a triangle like that, maybe like that.
Yep.
Maybe like the bottom part of the triangle is your foundation. That would be like your long term. And then maybe as you come up, midterm, and maybe a smaller portion is the short term,
Yep.
which would allow you a good, strong diversification. Even if, because I don't really know how the short term works. I don't know once they're vacant, how long it takes to fill it, and all the things that go along with it. But as long as you have a strong foundation of long term rentals, I think
Yep.
that's a good strategy.
I totally agree. I totally agree. By the way, with the technological advances, with the artificial intelligence, the future of real estate investing is very exciting because you have technology at your fingertips. Whether you are having a property manager manage all your rental property, you can become a
Right.
totally hands off or whatever, that's
Yes.
fine. And
Yes.
even if you pivot to a mid-term rental or short-term rental, it's in a way it's not that much work because there's so much resources available to you, so many software, so many technology. You can potentially manage all the three areas, short-term, mid-term, and long-term, at the comfort of your kitchen table. You can
Yes.
really do that regardless of where you live.
You can do it from anywhere in the world.
Absolutely. Anywhere in the world. Yeah.
Everything has the internet, which is everywhere.
Yeah.
You can do that, and I think that's very exciting.
Yeah.
Especially for us looking at our strategy as we're looking more towards retirement. We want to be able to travel and get up and go, and at the touch of a button, as long as we have our cell phone or our computer with us, we can manage our properties.
Exactly. Exactly. So the future of real estate investing is very bright because of advancement of technology. And there's so many new ways of doing things. We just keep an open mind and things will do well for investors.
Absolutely.
Anyway, current landlord, again, our goal, with my network, with my philosophy, still remains the same: buy long-term rental, annual lease. That's the foundation of a long-term systematic growth. However, if you want to, a lot of people out there, for whatever reason, you can pivot, you can convert your long-term rental portfolio, your houses in whatever area that you live in whatever part of the country, and you can potentially convert it to mid-term rental and short-term rental. If you commit it to mid-term rental, your projected rent could be at least 50 to 75% higher than your long-term rental projections. All right. So
Right.
again, buy your new long-term rentals or your existing rental property you have. Many of our investors within our network over the years, through our help, have purchased in a very good markets in Texas, in North Carolina, in Florida, and in Alabama, whatever. You may think about potentially using some of your portfolio to convert into a short-term or
Right.
mid-term rental, which is absolutely exciting. Let's discuss mid-term rental just a little bit. Mid-term rental is more than 30 days stay, less than 365 days. And it's an emerging asset class. The rental pool of people that want to rent your property during these time frames are traveling nurses. Imagine, right? Traveling nurses, that's such an amazing way
Right.
to if they go to a location, they spend 60 to 90 days traveling nurses to a location. They can rent your property for those times. You can charge higher rent. Not only that, healthcare professional, healthcare recruiting agencies, other medical professionals, contract workers, retirees, digital nomads, remote workers, college students, corporate rentals, military families doing temporary relocating. People lost their home during the fire. An insurance company will pay their rent for them, very high rent, while they rebuild. And people doing large home renovations on their own home, they need to live somewhere else for a few months. The possibilities of the rental pool that will rent your property during this short-term rental is endless. This is just a small sample. But again, every market is different. Every local neighborhood is different. Do your research. And I've been doing a lot of research myself. So I will continue to put out more information about medium-term rental moving forward to benefit our existing client and new investors that want to buy properties, that we can do the trifecta effect of buying long-term rental as a foundation. At some point in time, you can convert some or all your property into mid-term rental or short-term rental. Is all at your discretion. The ability to have options and choices are yours. So any thoughts on that so far? What are your thoughts?
So interesting. We have one of our properties, we do have a traveling nurse in the property, and she pays on time. One thing about traveling nurses, they're paid very well.
Yep.
They pay on time. They're gone most of the time because they do the 12-hour shifts at the hospital.
Right.
And she did sign up for just a regular lease, but the property is relatively close to a hospital. I'm thinking maybe in the future that could be a potential. That unit could be a potential for midterm, because like I said, traveling. I actually know a young lady, have a good friend who's a traveling nurse who actually lives in Vegas but is working here in California. I think that's a great way to diversify again your long-term strategy.
Absolutely. As a matter of fact, a couple of years ago, I have a traveling nurse rent my property in Hawaii. I didn't think of it. I never seeking a midterm rental person, but she just happened to be in an area to work for 6 to 9 months in a hospital, and she paid me higher rent, and I accepted her, and it's less than 1 year, but I collect a higher rent. So accidentally, I got into the midterm rental space without knowing it at that time.
Excellent. That's excellent. Yeah, very good. Lots of different options.
Oh, absolutely. Absolutely. Yep. All right. So additional benefit with midterm rental is midterm rentals are not subject to short-term rental regulation. We've been hearing about all these restrictions coming from different markets like New York City and Dallas, Texas, just to name a few. Many areas of the U.S., they frown upon short-term rentals, and understandable. But you can always pivot. You can always convert to midterm rental if you want. You don't have to sell the property at a loss. Anyway, let's go on. Of course, if you want to convert your property to a midterm rental, you have to fully furnish your property. It's not cheap, because typically you have to spend maybe like $5,000 per room to fully furnish. Like if you have a 3-bedroom house or 1 unit, or the fourplex is, by the way, 1 unit or the fourplex we use for our example. 2 of the units are 3-bedroom, 2-bath, and 2 of the units are 2-bedroom, 2-bath in that fourplex scenario that we used example for today's video. So anyway, to fully furnish the 3-bedroom unit typically costs you like $15,000. So do the math, but you have to calculate the return on an investment by charging a higher rate rent on a midterm rental to determine how long it takes to recoup the cost of your fully furnishing your property. Yeah. Furthermore, as a landlord, you pay the utility when you do a midterm rental. I would prefer to rent out the whole unit. I would probably not gonna rent out by the rooms. It's too much hassle, too much risk. Some of the resources that they can use to run your midterm rental property. Mostly you have to self-manage your property. You can do self-managing even remotely far away, but I believe in a future, not too distant future, there will be some property managers that are willing to manage your midterm rental for you, even though you're 2,000 or 3,000 miles away. So that's coming.
Oh, I believe that.
Yeah. So you can. Some people make the okay. I don't have any short-term rentals, and I don't think I want it because I can't deal with all the maintenance issues, and I'm a remote investor. I like to spend my time traveling, like I always has been. But a lot of people, they still want to look into a short-term rental, midterm rental. They can self-manage, and one of the resources we have available are in Furnish Finder. Furnish Finder, they can help you market the property. You just pay a small fee and put your property map marketing platform, and surprisingly, you may get a renter. You have a lot of flexibility, transition from your long-term rental into short-term, mid-term. You can still scale your property, buy multiple properties over time. You can do it remotely, passively. You can buy 10 or more combination of long-term rental, mid-term rental, and still spend only an hour per week managing your business. No, you don't have to be a full-time investor to do all these things. So you can grow your rental income exponentially, 10x, whatever. This trifecta effect is a tip of the iceberg, I believe. So in summary, let's use the same performer that we use, the fourplex. By the way, again, it doesn't have to be a fourplex. Could be a single family home, could be a duplex, could be a triplex, could be a beyond a fourplex, but I like 1 to 4 units. But I'm sure you do too.
Yeah.
In
Yeah.
summary, let's go with the numbers for the pro forma on the same $535,000 property we use for this example. Let's go to the pro forma. Let's go to the long-term pro forma. This is the fundamental basic foundation of my investment methodology, still long-term rental. As we discussed, monthly net cash flow of $1,000 per month, which is fine. You see the numbers right here. Everything looks good. Vacancy factors and maintenance or everything are fully disclosed here. So that's what you get for long-term rental. Then if you want to convert this fourplex, by the way, by having a fourplex, you have 4 different units. Imagine the flexibility of having a fourplex. One unit you could convert to a short-term rental. The second unit you can convert to mid-term rental. And the 2 other units, you can stay rented as a long-term rental. So is that amazing?
That's a great strategy. Yes, absolutely. Absolutely.
Yeah. In this market, the little bit of research that I've done in South Texas on these fourplex that we're promoting, I believe they allow short-term rental and mid-term rental. So investor, when you buy these kind of properties, long-term investing is your main foundation, but you can do more research. And if you want to, convert into a midterm or short-term rental. Okay, this is long-term formula. Now, the next formula is a short-term rental. Short-term rental, you expect your rent to increase around 100% of your long-term rental rates. Okay, that is the theoretical expectation, right? That could be more, could be less. Depends on what area of the country, right? Because short-term rental, there are so many different type of asset class, so many different locations you can do short-term rental, right? So I'm just giving you a broad-based, high-level brush. So long-term rental, if you convert this to long-term rental, I put like a vacancy rate of 15%, a higher maintenance fee, of course, of 10%. Of course, your rent will be double the long-term rent. So you rent per month, it could be $10,000. Then you juggle the numbers and all that. At the end of the day, the monthly net cash flow is almost $4,000.
That's
right?
amazing.
Yeah,
That's life-changing money.
Yeah, it's more headache, a little bit more stress, more time out of your day, even though you may delegate some of the work to local people to help you clean the property or whatever. But still, it's give and take. It's pros and cons, right? Short-term rental, you have to more time out of your day. You have to spend more time. But at the end of the day, if you do it right, whatever market you're in, as you can see clearly, the cash flow is a lot higher than long-term rental, right? So this is a short-term rental strategy. And then let's go over the final trifecta, the mid-term rental pro forma on this fourplex property. Again, the assumption is by doing a mid-term rental, 30 days or longer and less than 365 days, you're able to charge 50% more rent on a per month basis than a long-term rental. So 50% of 5,300 from a long-term rental equals 8,100 approximately gross rent. And of course, you change the assumptions, the vacancy rate if at least 10%, maintenance percent at least 5% or more. At the end of the day, by the way, you have to spend additional $50,000 or more to fully furnish the 4 units. For example, more out of pocket, as you can see, down payment plus closing costs plus the furnished rental cost, almost $200,000. But at the same time, your monthly net cash flow on a mid-term rental is a little bit more than $3,000 net monthly cash flow, right?
That's amazing. That's
Yeah,
amazing.
it is amazing. And the last slideshow here is this is the great legendary investor
Mhm.
Mr. Warren Buffett. He said, "Be fearful when others are greedy, and be greedy when others are fearful." There's a
Mhm.
lot of fear out there. It's a great time for savvy investors like you and I and others to take advantage of the fear, because you can be greedy. You can be greedy in a good way and capitalize on these amazing opportunities we have
Mhm.
before us.
Right.
So, yes, as we conclude this person, the risk investing is never a bad time to buy real estate, regardless of the economic conditions, regardless of all the crazy negative headlines out there. You, you focus on long term, never wrong time to buy. So
Mhm.
again, so you can keep your multiple property, you can accumulate over time, strictly short term, long term rental. Nothing wrong with that. You can still do very well long term, but giving the profit opportunities with cash flow and everything else, there's nothing wrong to think about converting to a mid-term rental or short-term rental. So that's my takeaway. So what is your takeaway from this presentation?
This was really good, and I really like that a couple slides back when you were talking about doing the midterm and short term, really allowing people to understand that there are more responsibilities, like with the furnishing and how much it's gonna cost, because I think a lot of people that I talk to have a very simplistic view about, "Oh, you just buy a house and you throw people in there and you're gonna make all this money." And yes, but you get a little more reward, but there's a little more risk too. There's a little more involved too. So I think it's important. They're all excellent strategies, but just understand the risks and the rewards that go with each
Yep.
one. And I think the key is diversification. It's like any investment, like you and I, we've had mutual fund stocks, or when you're investing in the stock market, the broker, which I used to be one, we always would stress diversification. Like you just don't
Yep.
buy one and just put all your money into like one
Yep.
stock or
Exactly.
one mutual fund. You have to create diversification so that you get balance. And so I think this is a great way to have a diversified real estate portfolio, but just do your homework and understand the risks and the rewards that go with each strategy.
Absolutely. And surround yourself with a trusted team of financial
Yes.
professionals
Yes.
in that have boots on the ground for
Mhm.
whatever market you're in. So yeah, just work as a team. And yeah, Julie, we have
Mhm.
some great partners in many markets throughout the
Mhm.
country that who does one-stop shop in property management, and we have a good team together within our networks. Yeah, so that's what we do. Anyway, Julie, really appreciate. Thank you
Thank
for
you.
attending. You provide some very good perspective. You put yourself in the shoes of a risk
Yeah.
investor as you look into this kind of strategy. So the future of real estate investing is very bright. So we people take the plunge, be courageous, overcome fear, and take
Yes.
action, and you're going to be rewarded in down the road in the future. So it's not a quick scheme.
Right.
It takes a while to make it.
Like any other business. If you
Mhm.
look at it as a business, it doesn't matter what business you start, you're not going to make money overnight. And I think you
Exactly.
do have to have that long-term strategy. And again, stressing the team that you work with. And I just have to give a shout out to my team up in Buffalo, a property management team. They are just amazing. And it's really about, and I heard this early on, it's about building relationships.
Yep.
We have built an amazing relationship with our property management team, and I just want to give them a shout out because of the 6 properties, I have one that's a problem child, which if you had 6 kids, probably one of them would be a problem child. And I think people are always wondering, like, and I just want to be very transparent and honest. They're wondering, "Oh, do
Yeah.
you have any problems? Are the tenants doing anything?" And this one property we haven't had in a long time. We just closed in February this year. And we got in a tenant, and he did really well for about the first 4 months, and then he decided to stop paying. So we went through the eviction process, got him out, and he wasn't real kind to the property. So now we're having to go through that purpose of
Yeah.
fixing the property, but my property management team is doing everything and just
Yeah.
talking about relationship, we have built such an amazing relationship with these people because my biggest concern is, oh, now I'm gonna have to come up with some money to pay for the repairs. What they are willing to do with us, they are gonna split the cost of it because they're so concerned about us being happy with the property.
Yep. Yep.
They're gonna split the cost with us, and they're not even asking for me to pay anything up front. They're just gonna take it out of their rent
Oh,
once they get the property rented. So it's to their advantage to get it prepared quickly and get it back on the market because again, they only make money if I'm making money.
yep.
And that was just such a blessing to me because it's like that is the power of working with a team. And
Yep.
yeah, you are going to have problems. Nothing is seamless and nothing is flawless. But again, when you've got 5 of the properties that are producing, you can afford to have one out of commission for a month or
Yep.
2 because you still have others that the other 5 that are bringing in. So
Yep.
I just really want to encourage people. You said fear, get past the fear and just do it. Like we talked about last time, just do
Yep.
it
That's
because
right.
I'm glad we did it when we did. I wish we would have met you 10 years ago, but we met you when we met you.
Mhm.
And I know this is going to be a long-term strategy that's going to pay off very well for us. And so just hearing about the other options, the midterm and the short term is just really more exciting for me because it just gives us more options to look at in the future.
Great. Thank you so much. And I really appreciate your great testimonials, great comments once again. And you're great. Yeah, you have a good mindset, positive mindset. That's the key to our long-term success. Once again, thank you so much, Julie, for your time.
Thank you.
And
This
I
has been
hope
great.
hope everybody see the value of this presentation. If you do, please smash the like button and subscribe to my YouTube channel. And for those of you who are not already my member of my network, please at the bottom of my video, put down your email or my website so you can become a free member of our real estate network organization. Thank you so much. This is Seewing
Thank
Yee.
you.
Thanks for attending. Julie, you too. Thank you so much. Have a nice day.